Well, look, expectations for company profit growth going into reporting season were somewhat subdued, and despite this, there was a marginally disappointing reporting season that was delivered. If you have a look at the number of companies that beat expectations, it was about 15% in the ASX 200 versus 25% in the previous reporting season, so the February reporting season. If you look at the number of companies that missed expectations, it was about 27% versus a lower number of 18% in February. So more misses and lower beats during this reporting season. And if we look at how those earnings were distributed, the overall market grew earnings about 18%. That's a great number. If we excluded commodities, which had growth of over 100%, the growth rate is much more subdued at about 6% growth overall, spread across the financials. Of note, the real estate investment trust, so property, was quite subdued at around 2%, but there was some good results in segments of the industrials market, which helped lift that overall number to 6%. Look, the key takeaways during reporting season were that excluding resources, growth was fairly subdued at about the mid-single digit type level for corporate Australia. Within that, the large companies performed worse. So we saw more misses, earnings misses in large companies, with 33% of the top 100 companies missing expectations by 3% or more, and only 13% of top 100 companies beating expectations by 3% or more. The outlook statements from a whole range and the majority of companies was somewhat underwhelming and subdued going into next year. What we did see on the positive side, or potentially positive side, was a lift in capital spending expectations or intentions going into 2018. Whether that's a good thing or a bad thing is yet to be established. If they're spending capital on growth projects and generating future returns, that's a good outcome. If they've merely been on a bit of a capital holiday and underspending in their business and it's catch up, then that's not necessarily a good thing. That could be construed as a bad outcome. Names that spring to mind are companies like Telstra, which is having a degree of catch up and it's forcing them to cut their dividend. Resource companies are also in that boat where they've been underinvesting, commodity prices have now risen and there's a bit of catch up there. And I think the last key thing for us out of reporting season was really around capital management and dividend payout ratios, which we've seen peak in Australia. So over the last few years, we've seen payout ratios going one way. We've now seen that start to track back. Some of that's due to just they've reached a maximum amount of dividends that they can pay out and continuing to invest in their business, and other things like a catch up on capital spending and operational expense spending means that dividends are becoming somewhat more difficult to grow from here. I think the outlook for the 2018 coming year was probably the most underwhelming feature for us of the recent reporting season. So we had a range of soft or underwhelming outlook statements by companies, by corporates, and we saw consensus earnings expectations for the year reduced by about 2%. And that's a material number because consensus expectations for growth for the whole market for next year sits at around 2%. What you'll see on the slide we're showing you is that the resources number is negative at the moment. That's wrong. We expect that to be upgraded, and the reason being is consensus forecasts are set off a range of commodity forecasts. Commodity forecasts are all well below spot prices at the moment, so we will see that upgraded as we go through the year. If we're to adjust for that, earnings growth for the market will be about 5 to 6%. But if we exclude resources, it's somewhat lower at about 4%. And the most noticeable step down is bank profitability, which grew around 6% last year, is expected to grow around half that rate, or around 3% into 2018. Real estate investment trusts, again in that 2 to 3% type growth level. And if we look across into industrials, it's somewhat higher at about 7%, which looks optimistic to us. Revenue growth is quite subdued, and we're seeing some catch up in terms of operational spending and capital spending, and we expect those numbers to be reduced as we move throughout the year. Looking forward, we think there are actually more challenges for corporate Australia than opportunities at the moment. Corporate profitability is not reflecting the recent uptick in NAB business survey conditions, and that's because if you dig under the numbers, that uptick's being driven by a bounce back in really performing Queensland and WA state that are resources states. New South Wales and Victoria are actually showing signs of slightly moderating. But we think the pressures are broader than that. We think that the consumer is under considerable pressure. Wage growth around 2%, but rising utility and energy costs. We think the residential housing cycle is peaking, showing signs of peaking. So equity withdrawal and house appreciation will slow from where we're sitting now. We think the banks are facing much lower credit growth rates and potentially a pickup in bad and doubtful debt charges as some of these other cyclical factors sort of play out, which will impact profitability. One bright spot is really China and commodities, which continue to sort of chock along. However, commodity prices have moved up really, really highly, and we expect, iron ore and coal will start to trend back down. So the way the market looks at that is it looks forward. So it's looking at where prices are in 12, 18, 24 months out from now. So that growth boost from commodities is likely to wane. And then we think there's just a whole heap of pressures from global competitors entering some really big competition spaces, such as retail. The Amazons, the eBays, the Googles are going to pressure a whole raft of large employers. And where we think about this is we need to be incredibly active in the way that we manage money, because a whole range of Australia's largest listed companies are facing new pressures and new threats. And if you own, say, a passive or an ETF type instrument to get exposure to the ASX 200, by that definition, you're going to own a lot larger and a lot more losers than you're going to own winners. The outlook for returns in the Australian equity market is around the mid-single digit level from where we're sitting at the moment. One thing that we're really focused on and considering though is the large market cap bias within that, where we think a number of these companies are facing some challenges. So if you look at the construct of our index, you've got 4 banks, a telecommunications company that's facing a few challenges, 2 large retailers in Wesfarmers and Woolworths, and 2 resource companies in BHP and Rio that make up over 50% of the market cap of our index. So given the challenges facing some of these companies, we think you've actually got to look a little bit broader to get a better return in the market. So moving into some of the smaller companies and the mid-cap companies that have characteristics such as structural growth or larger market opportunities, we think are going to be really critical in actively managing to get a return for our investors.